So I have a great discussion for us today that we're going to be looking at. And what I was thinking about talking about today was cost versus value. I think that that's a discussion right now that we need to have, because the cost of things are going up. The cost of food is going up. Cost of gas as gas has gone up. There's a lot of expenses that are going up right now. We've seen the highest inflation rates within 40 years. So cost versus value is going to be a conversation that people are going to have. I mean, if it costs much more to go out to eat, are we still going to find the value in going out to eat? Well, most of us say yeah, because most of us are still going out to restaurants and stuff like that. So let me go ahead and share my screen here. I put together a little presentation, as I always do, for these events here. And let me start my slideshow here. Okay, I'm sharing the wrong screen. So let me do a new share and share this one. Okay, hopefully everybody's on the right screen there, and hopefully I'm sharing the right screen here. You are sharing this screen. Okay. I'm sure this is what you guys tuned in for, want to see, is me trying to figure out how to share the correct screen here. So this is me. This is Zach Smith of Chariot Financial. I'm just going to make sure I have the right screen shared there. Okay, there we go. I think that's the right one, by golly. Okay, I think we have the right screen shared. So if you're watching this recording, you could have just fast forwarded through all of that right there. You don't have to mess around with me, trying to figure this thing out here. So thanks for tuning in. Cost versus value. I think this is going to be a pretty good question that all of us are going to have to ask ourselves with costs going up. So this is me, Zach Smith. I own Chariot Financial, mychariotloan.com. So what is more important, cost or value? So again, the cost is the cost of a product or service is the amount you spend to produce it. In this case, in my case with my business, I don't really have I have a very tight grip on the costs for my business and the costs I charge my clients and things like that, which is one of the reasons why I went off on my own. I've worked for large lenders, I've worked for retail lenders, and I went off on my own about 4 years ago. And this is one of the major reasons I did, was because I wanted to offer better pricing and better costs to my clients. But when it comes to the market, when it comes to the cost of money, I don't have any control over that. Really, none of us do. So that's really the situation we're in now. So the value is what your customer believes the product or service is worth to them. So what is the value of something? I mean, if you really want a bowl of cereal, like you really want, this is probably a bad example, but if you really want milk, you're going to pay whatever it costs for it. A good example, that's not a very good example, but a good example is the play from Shakespeare, King Richard III, My Kingdom for a Horse. So let's talk about that for a second. So My Kingdom for a Horse is a quotation from Act 5, Scene 4 of Shakespeare's Richard III. At the end of the play, Richard has lost his horse on the battlefield, and we see his extreme frustration. Richard's opponent, Richmond, has sent men out on the battlefield as decoys, dressed like him. Richard has killed 5 of them, but Richmond himself has eluded him and is now hunting him down. Richard has done well without a horse, but has no chance now with Richmond closing in on him. So at that point, he yells out and says, my kingdom, my kingdom, my kingdom for a horse. So he's willing to trade his entire kingdom, everything he has, for a horse, because it has to do with his own survival. So the value of the horse prior to that event is probably not very valuable to him. It's probably the value of any horse. But at that moment, that horse is extremely valuable to him. I mean, it's so the value, cost versus value for him went up extremely high because he was in a situation where he desperately needed to get bailed out. He needed a horse to get out of there, and he didn't have one. So the value is going to depend on people's specific situations. This is a great quote from Harlan Akela. Too often and this is really geared towards the reverse mortgage side of things. This is just a general quote that I wanted to quote about the reverse mortgage in general. I try to focus these talks mainly on reverse mortgage because that is our specialty here at Chariot Financial. So too often, all of us focus on the price, the cost, instead of the value. For a retirement plan, as any endeavor, it is important to assess what the goal is, not just small pieces of the effort. Very few people have the goal of dying with the most equity in their home, but most advisors and their clients make decisions to reach that goal by default. In reality, it doesn't make sense to put hundreds of thousands of dollars into an illiquid asset during our retirement years, but our culture is very used to doing that. It's a very interesting quote by Harlan. I think a lot of people are just kind of, we're just kind of used to doing things the way we've always done them. And, if we do what we've always done, we get what we've always gotten. And, that works out for a lot of people. A lot of people, they are able to live a very healthy, great retirement that way. But not everybody's situation is cut and dry like that. Some people are on that battlefield right now and they're searching for a horse and they need a horse. So that creates an issue. It creates a cost versus value issue, which is what we're talking about today here. So what is the biggest thing that people want? I mean, it's been my experience that most people want peace of mind. We can accumulate a lot of material wealth, or we can accumulate not much material wealth. But if you take someone who is very wealthy and someone who is not very wealthy, anybody all over the world, what are we looking for? We're looking for peace of mind. Well, right now, a lot of Americans are struggling with that. I mean, with the pandemic and how things have gone over the last few years, I mean, peace of mind is at a premium right now, and that people are willing to do what they can to create this peace of mind for themselves, which is, human nature. So what's one of the biggest stressors that people have besides their health? Usually it's finances. So right now, more than 3 in 4 Americans, that means if you're in a car with 4 people, 3 of them report feeling anxious about their financial situation, according to a new Mind Over Money survey by Capital One and the Decision Lab. Financial worries include a broad range of issues, from savings and retirement to affording a house or a child's education. It's a huge concern. I don't really need to go into much detail about this because I think a lot of us have experienced this. I mean, based on this survey, 77% of people have anxiety about this. And, with the cost of goods going up, the cost of lending, all these things are going up because of the record inflation. It's a very real concern for a lot of retirees, for a lot of Americans in general. So let me talk a little bit on the mortgage side about cost versus value. So this is the first example that I put together here for this presentation. And so let's take, these last few years, wow, interest rates have been in the 2s. I mean, we've had some low interest rates, and a lot of people have taken advantage of this and refinanced their homes, which is great. I mean, it's great to get down to a lower rate. Why pay the bank more money if you don't need to? So right now, you have a lot of people who are in low rates. So, why would you trade in that low rate for a higher rate? And quite frankly, I'm not going to sugarcoat it for you. Anybody watching this video, I want you to know that I'm going to be straight up honest with you. You shouldn't do it. You really shouldn't. I know that's bad for my business, but you shouldn't trade in a lower rate for a higher one. You really shouldn't. That's why people are, oh, get a 15-year mortgage. I'm not a big fan of 15-year mortgages, but you do pay a lot less interest. The reason I don't like 15-year mortgages is that you can still pay a 30-year mortgage off in 15 years. You're just not forced to. So, but to get back to this example, why would you trade in a lower rate for a higher rate? It doesn't make sense unless you find value in it. And let's take a look at this. So right now, this person will just, normal average person has 3.5 interest rate and $480,000 balance on their mortgage. And they're paying about $21.55 per month. Not bad, right? Hey, 3.5%. They're living pretty good right now. Well, it just so happens that their car broke down and they needed to go out and get another car. So they got another car. They went out and the other car broke down. Well, now that we're going back to the office, now that things are picking up a little bit, we do need transportation. And any of us who've been out there at meetings and things like that, I mean, the traffic is a good example of how, things are coming back, because there's a lot of traffic out there. Now, of course, in my opinion, I think we should be investing in more public transportation and bringing grocery stores locally, farm to market, all that stuff. But that's another conversation for another day. If you ever want to have that conversation, just give me a call. But for the purposes of this presentation, let's just say they have 2 car notes that they're paying. They had to go out and get 2 cars. Well, credit cards, wow, credit cards are tied to that federal interest rate increases. So people are seeing that their credit cards are costing a lot more. The borrowing costs are going up. So now your credit cards are, could be 15, 20, 30%. I mean, who knows? I don't know if 30% is accurate. I'm sure there's somebody out there paying 30%. But for this example, we don't know what they are, but they're going up and they have gone up. So even though they have that nice, shiny 3.5% interest rate, and again, I want to be very clear about this. I'm not advocating that you change that in for a higher rate, but there are people who could find value in that. For example, if you're paying those 2 car notes at $550, and honestly, again, I'm not a proponent of doing this, but people are going to find value in this. Is it the smart thing to do? Probably not. And I'm just being upfront and honest with everybody on the video here. It's probably not a smart thing to do to trade your interest rate in for a higher one. But if you find value in it, you're absolutely going to do it. For example, if you went out and you accumulated this debt already, the $38,000 in the first car, the $26,000 in the second car, the $19,000 in credit card debt, if that's already there, you've got a couple options here. You can just find a way to pay that debt off each month, even though you're paying really high interest rates on those credit cards. You'd have to be very disciplined. And in some cases, people aren't going to be able to pay that debt off. So we may see bankruptcies and things like that. So one option is that you could continue to pay that debt off. So the total amount that people are paying right now in this specific scenario is about $42.55. Now, what if they were to refinance that mortgage and roll this debt into the mortgage? And again, I don't think it's a great idea to do that, but if you've already got the debt, you've already made the decision, or you've already had to make the decision. Life happens. Things happen. I mean, there's one constant in life, right? Change. So when things happen and you accumulate debt, it's already there. So if it's already there, you could put yourself in a position to roll that debt into the mortgage. Now that's going to stretch out that debt. You're going to be paying your credit cards for 30 years. You're going to be paying your car note for 30 years. Well, that's, basically if you carry that note out all the way to the end, which very rarely people do. But if you do carry it out to the end, you're going to be rolling that debt in and paying for it for 30 years. But you're also going to be freeing up about $510 per month by rolling that debt into your mortgage. Now, the key thing here is that your interest rate is going to double, 3.5% to 7%. Now, we're pricing out pretty low. Again, that's the reason I created Chariot Financials. I wanted to have more autonomy over my pricing. When you work for large banks and large companies, you don't really have a whole lot of leeway. I mean, this is their product and that's what you get. But as an owner, I'm able to price things out or set my agreements up with the banks so that I can price things out very aggressively for people. In this instance, this person may be looking at this saying, you know what, I could really use an extra $500 a month. That, I have these other bills coming up, or I have something else coming up, or, so if someone finds enough value in that $510, well, yeah, they're going to trade that 3.5% for a 7% because they see more value in paying $510 less. I mean, it's kind of like King Richard, cost of a horse went up exponentially once he really needed one. And if you have the cost of living going up in all other areas and you can find a way to get another $500 each month and pay off your car notes, those are completely your cars now, pay off all your credit cards, then you're going to be in a position where you're going to find value in switching that rate from 3.5 to 7. Next example here. So this is a reverse mortgage example. So this is a different scenario. A lot of times people with reverse mortgages have a smaller loan balance because in order to qualify for a reverse mortgage, they're basically somewhat like life insurance policies in the sense that they're going to use actuary tables. So someone who is 62 can qualify for less property or less of a loan amount than someone who is 82. But a lot of times you'll have a lower loan balance because we can't go as high on what they call the loan to value on those. So in this specific situation, their loan balance is right around 150, and we'll just say they're paying $1150 per month. They have car number 1, car number 2, and the credit cards. So again, they're going to be switching an interest rate of 3.5% for a 7. Anybody will tell you, if you showed this situation to your financial planner, he would say, are you crazy? Or why are you switching one rate for the other? You're almost doubling your interest rate. Well, the answer is you're finding value. Yes, is it the conventional thing to do to switch out the lower interest rate for the higher interest rate? No, that is not the conventional thing to do. But if you find value in doing it, then people are going to be more apt to do that. For example, in this situation, with a reverse mortgage, required payment amount is 0. Yes, there is a monthly payment with the reverse mortgage. Yes, if you want to pay a monthly payment, you can pay it, but it's just not required. So that's the big difference between a reverse mortgage and a forward mortgage, is that you're not required to make that monthly payment. So basically, we would roll all the mortgage, the car notes, the credit cards, we would roll all of those into the reverse mortgage and convert those to a payment optional plan. Now, the balance on your loan is going to go up over time, but you're also going to free up about $32.50 each month. So in retirement, one of the biggest things that people struggle with is cash flow. We're living off of fixed incomes, or maybe we want to retire and we don't want to go out and work, 40 hours every week. I can't begin to tell you how many people are still doing that because they can't afford to retire. But with this type of setup, if they were to roll all the debt into it, even though their interest rate is going up, they may find value in that because they've just freed up $3,200 of income. So they can safely live in that property the rest of their lives and save that $3,250. Now, of course, you have to take into account that those car loans would be paid off probably in 6 or 7 years, credit cards, but you could also look at it another way and say, well, they could take that $3,250 and just put it into these high yield bonds that are coming out right now. There are always bad things that are happening because the rates are going up. Some of these savings investments are getting a little more attractive. Well, thanks for tuning in. This is me. I'm Zach Smith. I own Chariot Financial. I hope you found something educational out of this. And if there's anything I can do for you, I'm just a phone call away. Thank you so much, and I hope you have a blessed day.